The late 1990s witnessed a period of unprecedented technological advancement and economic growth, fueled by the rise of the Internet. This era, known as the dot-com bubble, was a time of both immense opportunity and reckless speculation. The Internet was new, exciting, and poised to change the world. Investors were eager to get in on the ground floor of what they believed would be a technological revolution. The dot-com bubble was characterized by a surge in the stock prices of Internet-based companies, often referred to as dot-coms, due to their .com web addresses. These companies, many of which had yet to generate any significant revenue, let alone profits, were valued based on their potential to disrupt traditional industries and capture market share in the burgeoning online world. Investors, blinded by the hype and the promise of astronomical returns, poured billions of dollars into these fledgling companies. This speculative frenzy created a disconnect between the valuations of dot-com companies and their underlying fundamentals. Traditional metrics such as price-to-earnings ratios were rendered meaningless as investors focused solely on a company's online presence and growth potential. The fear of missing out, or FOMO, was palpable, driving investors to make irrational decisions based on speculation and herd mentality rather than sound investment principles. However, as with all bubbles, the dot-com bubble was not sustainable. The lack of a solid foundation, coupled with the overvaluation of many dot-com companies, eventually led to a market correction of epic proportions. The bursting of the dot-com bubble serves as a cautionary tale about the dangers of speculation and the importance of sound investment strategies. To understand the dot-com bubble, we need to go back to its roots, the rise of the Internet. The Internet, once a niche technology used primarily by academics and researchers, was rapidly becoming mainstream. The development of the World Wide Web in the early 1990s made the Internet more accessible to the general public, opening up a world of possibilities. With the Internet, information could be shared instantly across the globe, connecting people and businesses in ways never before imagined. E-commerce emerged as a new frontier, promising to revolutionize the way we shop and do business. The potential of the Internet seemed limitless, and entrepreneurs and investors alike were eager to capitalize on this transformative technology. The rise of the Internet created a gold rush mentality, with countless startups emerging, all vying for a piece of the digital pie. These companies, with their innovative ideas and disruptive business models, captured the imagination of investors. Venture capitalists, eager to fund the next big thing, poured money into these startups, fueling their rapid growth. The media played a significant role in hyping the dot-com boom. Newspapers, magazines, and television channels were filled with stories of overnight millionaires and the transformative power of the Internet. This constant barrage of positive news created an atmosphere of euphoria, leading many to believe that the dot-com boom would last forever. As the Internet gained traction, so did investor enthusiasm for anything and everything.com. This period, often dubbed the irrational exuberance phase, saw a dramatic disconnect between a company's actual value and its stock price. Companies with little more than a website and a dream were going public and seeing their valuations skyrocket. The traditional metrics used to evaluate companies, such as earnings per share and price-to-earnings ratios, were thrown out the window. Investors, caught up in the hype, were more interested in a company's story and its potential for future growth than its current financial performance. This led to a situation where companies with no profits and in some cases no revenue were valued at billions of dollars. Adding fuel to the fire was the rise of day trading. The accessibility of online trading platforms allowed individual investors to buy and sell stocks with ease, often from the comfort of their own homes. This led to a surge in speculative trading, with many individuals quitting their jobs to become day traders, hoping to get rich quick by riding the dot-com wave. The media, as mentioned before, played a crucial role in inflating the bubble. Stories of dot-com millionaires were commonplace, further fueling the frenzy. This created a feedback loop, with positive news coverage driving up stock prices, which in turn led to more positive news coverage. The bubble continued to inflate, driven by speculation, hype, and a fear of missing out. Section 4. The kings of the dot-coms, companies that defined an era. The dot-com bubble wasn't just about market forces, it was about real companies, some of which became household names. Amazon, founded by Jeff Bezos, started as an online bookstore and became a pioneer in e-commerce. AOL dominated the dial-up era with its user-friendly interface and community focus. Pets.com epitomized the excesses of the dot-com bubble, but went bankrupt in 2000. These companies shaped the dot-com landscape with stories of both triumphs and failures. Section 5. The party's over, the bubble bursts. By early 2000, the warning signs were becoming increasingly difficult to ignore. The Federal Reserve, concerned about the overheated economy, began raising interest rates. This made it more expensive for dot-com companies to borrow money, slowing down their growth. At the same time, investors began to realize that many of these dot-com companies were not living up to the hype. Their business models were often flawed, and their paths to profitability were unclear. As investors started to question the valuations of these companies, the bubble began to deflate. The turning point came in March 2000, when the Nasdaq Composite Index, heavily weighted towards technology stocks, peaked at over 5,000 points. From there, it was all downhill. As investors rushed to sell their overvalued dot-com stocks, the market went into free fall. The Nasdaq lost over 75% of its value from its peak, wiping out trillions of dollars in market capitalization. The collapse of the dot-com bubble was swift and brutal. Countless dot-com companies, unable to secure additional funding, went bankrupt. The once heralded entrepreneurs became symbols of excess and failure. Investors who had poured their savings into these companies were left with nothing but worthless stock certificates. Section 6. Picking up the pieces. The aftermath of the dot-com crash. The bursting of the dot-com bubble had a profound impact on the economy and the investment landscape. The tech-heavy Nasdaq, which had been the darling of the late 1990s, took years to recover from the crash. Many individual investors, who had jumped into the market at its peak, lost their life savings. The dot-com crash also led to widespread job losses, particularly in the technology sector. Companies that had once been on hiring sprees were forced to lay off employees as their businesses struggled to survive. The unemployment rate rose and consumer confidence plummeted. However, the dot-com crash was not entirely a negative event. It served as a much-needed reality check for the market. The crash exposed the dangers of speculation and the importance of sound business fundamentals. It also led to a more cautious approach to investing, with investors paying closer attention to a company's financials and its long-term prospects. Moreover, the dot-com crash paved the way for a new generation of tech companies. The infrastructure built during the dot-com boom, such as the widespread adoption of broadband internet and the growth of e-commerce, created opportunities for companies that could leverage these technologies effectively. Section 7. Lessons learned, what we can take away from the dot-com bubble. The dot-com bubble, despite its tumultuous nature, offers valuable lessons for investors and entrepreneurs alike. The most important takeaway is the importance of sound business fundamentals. A company's long-term success depends on its ability to generate profits and create value for its customers, not just on hype or speculation. The dot-com bubble also highlights the dangers of herd mentality. When investors blindly follow the crowd, it can lead to asset bubbles and irrational market behavior. It's essential to conduct thorough research and make independent investment decisions based on facts rather than emotions. Another crucial lesson is the importance of diversification. Investing all your money in a single stock or sector, no matter how promising it may seem, is incredibly risky. Diversifying your portfolio across different asset classes can help mitigate risk and protect your investments. Finally, the dot-com bubble reminds us that markets are cyclical. Periods of rapid growth are often followed by corrections or even crashes. It's crucial to have a long-term investment horizon and to be prepared for market volatility.